Recording in progress.
Yeah. Good afternoon, everyone. So it gives me a great pleasure to welcome you all to today's session, Legal Legacy Beyond Borders, that is Navigating Cross Succession, which is hosted under the aegis of the Development of International Trade Services and WTO Directorate. On behalf of our leadership, entire leadership, CA Abhay Haje and other chairpersons, I extend my gratitude for your presence and participation. Now, succession has always been a part of human enterprise, but in today's interconnected world, it has become far more complex. Families, businesses, and assets now cross geographies, raising new challenges. Cross border taxation, cultural differences, evolving legal frameworks, and even questions of identity. At its core, though, succession is not just about legal structures, it's all about continuity, stewardship, and fairness across generations and across borders. This session is designed to reflect on exactly these dimensions and to help us navigate this sensitive and multifaceted subject, which we have with us esteemed expert who bring perspectives from law, finance, family governance, and practice. With that context, it's my privilege to invite CA Yog Bakshi sir to set the tone with their insights. Please join me in welcoming him. CA Yog Bakshi sir is a chartered accountant working with KC Mehta and Company LLM LLP, that's KCM, in the succession planning and transactions vertical. His role involves handling succession planning projects, designing and drafting wills, trusts, etc., and lending support in structuring tax FEMA planning. He advised multiple promoters, promoter families, and promoter groups with core focus on Indian family owned companies, which is listed or unlisted, including wealth and business succession planning for the promoters. He regularly contributes in professional publications like Tax Sutra, FGI Bulletin, and more. He has also been invited speaker on prestigious professional forums like Chambers of Tax Consultants. He has been instrumental in starting KCM's in-house publication, KCM Heirloom, which focuses on succession planning and estate planning. Thank you for joining, sir, and over to you, sir.
Yeah. Uh, First of all, thank you, Mayuri, for the great introduction. I think I could not have done better myself. Can you just tell me if the screen is visible?
Yes, sir.
Yeah. So good afternoon, friends. I think I extend my heartfelt gratitude to the Development of International Trade Services WTO Directorate of ICAI for inviting me as the speaker for this session on cross-border succession planning. Uh, the topic for today is Legacy Beyond Borders, Navigating Cross-Border Succession, which is a topic I think many of us may not be practicing in, but an emerging area of practice. And so kudos to the ICAI Directorate for selecting such an interesting topic, and also to the listeners today, so the viewers, for logging in at this hour on a weekday. Kudos to you guys. Generally, I see that chartered accountants have this zeal of learning, which inspires young charters like me to keep contributing and keep learning more and more. So, coming to the topic for today, friends, succession planning itself is a complicated process, as we all would have already dealt with in some manner or the other, either in tax litigation or possibly somewhere else, maybe compliances, etc. But the exercise in itself is full of complications, surprises, and personal preferences of the individuals. Added to that, the cross-border complexity. There are regulations of each country which you would have to go through and possibly navigate along the way. How you will manage practically dealing with those complications, and of course coordination between councils across the border also becomes an essential part of it. Uh, so how today's session is structured is that I plan to cover the fundamentals of succession planning to begin with, a brief touch on the core principles of succession planning, what are the elements of good succession plan, and thereafter navigating through the cross-border aspects, setting the context on cross-border theme, and introducing the cross-border complexities. And thereafter, most of my time would be spent today on evaluating each of the tools of succession planning, be it HUF, that is Hindu Undivided Families, be it wills, private trusts, gifts, family arrangements, etc. I'll be covering the cross-border complexities on each of these after giving a brief introduction on the basics of those instruments. So this is how I plan to take up the session today, and I hope I am able to maintain your faith in the quality of knowledge that this platform promises to provide. With that, I'll get down to the brass tacks. Yeah. So fundamentals of succession planning. Friends, to begin with, we must understand what is succession planning. So succession planning in simple words would be deciding today itself as to who will be the successor or manager of the property or the business, and how will the transition of such management or ownership take place. This is a very crucial decision because it involves thinking about a lot of aspects beyond law as well as the law itself. Now, there are two aspects which you may have to address during this succession planning. It's economic succession and management succession. What is economic succession? So succession in relation to ownership of the assets. Who has the ownership of the assets, the control of the assets, etc. Who realizes the benefits or returns of the assets. And then there is management succession. Succession in relation to the control of those assets, as to who deals with those assets, who decides what happens with those assets. This is another aspect which needs to be kept in mind. Now, having understood broadly what is succession planning, we must also understand what happens without planned succession. So as far as India is concerned, there is, if let's say, let's take an example, someone, Mr. X in India, dies without any planned succession. He has done nothing, not even written a will. What happens to the properties he owns? So depending on the faith Mr. X subscribes to, be him a Hindu, a Muslim, a Christian, a Parsi, a Jew, depending on his faith, the properties will flow according to the respective laws of intestate succession applicable to him. For instance, if he's a Hindu, the Hindu Succession Act 1965 56 would apply. And Hindu law is partially codified, partially uncodified. Uncodified to the extent that there are customs, practices, Ved, Smrutis, Shrutis, which have these rules pertaining to inheritance mentioned therein, and may not necessarily be codified through a formal law like Hindu Succession Act, as I said. It also so even Hindu Succession Act covers only limited areas of the Hindu law. Now, having said that, the Ved, Smruti, Shruti, etc. would not exactly be drafted in the sense of legal precision and always leaves room for interpretation and ambiguities. And the other source is obviously judge-made laws, which are decided by the judges in the courtrooms. This obviously you would have already figured out that leaving things to the Hindu law or any personal law for that matter would be prejudicial to the harmony or litigation free hopefulness of the promoter as far as the assets are concerned. So you would not want it to pass in a manner in which the law prescribes, and that too in an ambiguous manner likely to lead to litigation. There is also Muslim law, that is Sharia. Sharia in India is applicable to all Indian Muslims. However, only the application has been made under the law. So the law says that Sharia will apply to all Muslims, but it does not codify Sharia itself. So Muslim law as it stands today in India is entirely uncodified, again leading to ambiguities. Then there is, of course, Parsis, Jews, Christians, who are subject to Indian Succession Act 1925, which prescribes rules on intestate succession to them. Now, friends, having said all this, the bottom line is the consequence of uh, going away without planning your succession are basically unintended consequences which may accrue. There is a lack of clarity which may be there, and the inheritance will ultimately be highly susceptible to litigation. As far as businesses are concerned, let's say it's a controlling stake of a business that you are talking about as far as your succession is concerned. Family disputes may take precedence over the management and growth of the business in case you don't plan for succession in a timely manner. So these are the aspects which need to be kept in mind when you talk about the reasons why you should plan your succession. Now, having said that, what are the elements of a good succession plan which you would have to keep in mind irrespective of the instrument, etc., that you are thinking of? So, first principle that one must keep in mind is ensure that you are not left high and dry during your life. That is, uh, you give away most of your wealth during your lifetime. You don't have any cash flows left for you. There may arise a situation that in the emotion and the bias or sentiments of having faith in your children, etc., you ultimately end up transferring most of your ownership and wealth to your children, leaving almost nothing to yourself. And there is a situation where maybe you need to buy a car or a house, and you have to go ask for money from your children. So that is something which is also a public instance which has happened. An industrialist, which in the garment business, uh, has faced a similar situation. I will not take the name, but we all know. So the next point we'll take is mitigate the role of bias and sentiments in planning. So as I said, generally as a part of your succession plan, you will be required to think of aspects like who deserves this wealth, right? You would always try to think that, or maybe the client would always like to think that some person who is taking good care of them today is someone whom they can entrust the wealth with by giving them the compensation for their labor and the care they have taken. Things may change in the future, and that person may not be exactly the person you would like to devote the wealth to. Irrespective of whether things change in future or not, the plan should always be fair. Because if it is not fair, then you are allowing room for litigation in the future. These are the two aspects which I would like to highlight on this point. The third point is proper documentation. So whenever there is a succession planning exercise going on, there has to be clear-cut documentation without any uh, lack of clarity. Why? Because as much as you would like to keep things open and flexible, proper documentation ensures that room for litigation again is reduced after you are no more. And there is extreme clarity, so the executor or the fiduciary who will be handling your assets is not supposed to approach the court now and again just to get things straight. Another aspect is incorporate flexibility. While you should ensure that your succession plan is clear and has a clear route of the flow of assets from one person to another, you must also incorporate flexibility so that in case situations, laws, internal or external, change in the future, you are able to adjust that by virtue of amending the documents which you may have placed with necessary restrictions and controls. Now, generally, friends, when we think of succession plan, we think only of death. However, we must also consider incapacity. There can be permanent or temporary incapacity. Recently, there was a case, I think Sandhya Anil Kumar's case in Karnataka High Court, where the husband was in a unfortunately comatose state for 9 months, and the wife could not access a penny of the funds lying in his bank account because he had written a will, but he had not died yet. Wills are enforceable only on death. And this was a case, live case, where you could see how not planning for incapacity can lead to tragic circumstances. Uh, the last point is buy-in from all concerned family members. Now, this is a very thin line to tread, and often in practice, you would see that people are afraid of navigating in this gray area of transparency versus confidentiality. You would like to think as a wealth owner that I'll dispose of the assets while I am alive according to my wishes. And maybe I'll get away by not telling the beneficiaries who are in the will, who are not in the will, or who may be beneficiaries of the trust, etc., and how things will work out. But generally, this is likely to lead to one of two things. Maybe your family members are not aware of the amount of wealth you have amassed, and possibly they are left out just because of the lack of knowledge regarding the assets that you may have. There is another aspect that acrimonious relations may arise due to not taking the buy-in from all concerned family members, and just in order to make some vengeful lawsuit, they'll be making things difficult for the people whom you care about. So these are the aspects which need to be kept in mind. And lastly, tax can be a factor. Tax is a factor certainly in terms of any transaction which you are thinking about, any transfer of asset you are thinking about. But it should not be the sole motive for using tools like wills, HUFs, trusts, etc. Misuses can often prove harmful, and I think also be covering some aspects of this statement in the next few slides. Now, setting the context for today's discussion, cross-border, what do you mean when you say cross-border succession? So, having understood succession itself, cross-border succession, when we say it involves the wealth owner, the beneficiary, and the location of assets, which may be in different jurisdictions. So, let's say wealth owner may be a resident in India, maybe a US citizen. The beneficiaries may be residents and nationals of US itself. And the location of wealth could be spread out across the world. For instance, there could be a real estate investment in UAE lying with the wealth owner. There could be some assets lying in, let's say, uh, uh, Canada. There could be some other assets in UK and so on. So here are where laws of these countries would also intermingle with themselves, and possibly the formalities also need to be kept in mind. And this leads to many other complications over and above the existing succession aspect. The tools, however, irrespective of the cross-border complications, remain the same. These are the enduring basics, as I would call it. Uh, there are HUFs, Hindu undivided families in the Indian context. There are gifts and family arrangements which you may have. There are wills, private family trusts, or foundation is an emerging concept, well established in some jurisdictions like United Arab Emirates. There are family constitutions which are used in order to govern the family relations. These are the five types of instruments, and even there are more simpler tools like joint holding, power of attorneys, nominations, etc., which can also be relevant in order to ensure that things move in tandem as far as your succession plan is concerned. I'll be taking up each of these instruments in some detail and the cross-border context, as I mentioned earlier. Now, cross-border complications, when I said in the earlier slides, what do I mean by cross-border complications? So, which succession laws to apply? We'll see this in detail going forward. But in the earlier example, when I mentioned that Mr. X is an Indian resident, a US citizen, his children are US citizens and residents, and he has properties across the world. And let's say Mr. X dies in India itself. Which law of succession would apply? Would it be Indian law of succession which would apply to him? Would it be US laws of succession which would apply to him? Or would it be the location of asset which would determine the law of succession which would apply to him? These are the aspects which need to be clarified before commencing the exercise of succession planning itself, in order to have a clear idea of where to look at while planning for succession. There are family laws again in addition to succession laws, which may be relevant in your succession planning exercise. Family laws of different countries, especially relating to matrimony, that is marrying and divorce, the laws which govern these two aspects are necessary to understand, because these affect the claim on assets forming part of the bequest. Taking a very basic example, United States of America has the concept of community of property. Community of property in a nutshell, if I were to say, would be where the husband and wife both have equal part of the property ownership, which is not prevalent in India, as far as the Hindu law is concerned, at least. So the self-acquired property would be owned by one of the spouses, and the other counterpart would not be able to claim on the assets, irrespective of the marriage or divorce. This is what the standard in India is. So these family laws will also affect your succession planning, because there may be a case of cross-border marriages which may be there. Then there are, of course, estate duty and inheritance taxes in countries like US, UK, Germany, and many more. And these are extremely draconian duties, because these are around 40%. For example, US has a 40% estate duty on the covered assets. And that can extend up to, this 40% is a federal estate duty. It can extend up to 56% in total, should it be an additional state inheritance tax levy as well. So that aspect also needs to be kept in mind for sure, because you are not planning in order to erode your estate. You are planning to protect it. Then there is the Indian element, the FEMA implications. So India has this Foreign Exchange Management Act 1999, and some restrictions on capital account convertibility, which will also affect your succession plan in some way or the other. Clarity on these aspects is extremely essential. Lastly, there are foreign law compliances which apply on your estate. So, for instance, you may set up a trust in India which may hold a foreign asset or something, or a foreign trust which may hold an Indian asset, etc. This may have to be reported in Schedule FA in your Indian income tax return, and missing that would be unnecessary punitive actions from the authorities or penalties, etc. So, friends, bottom line again is cross-border elements add to the already complex exercise of succession planning, and navigating these aspects is the first step possibly before jumping onto the softer aspects of succession planning. Right. So coming to conflict of laws, taking a different example here. Just Mr. X, an Indian citizen, resides in the Kingdom of Saudi Arabia with his family. His family consists of his wife and two children, a son and a daughter. Mr. X has a permanent residence in Kingdom of Saudi Arabia, right? He holds some land and real estate in the UK and shares in a listed company in India. He writes a will. Which country's law of succession should apply to Mr. X? So here, interestingly, what happens is, although he's an Indian citizen, he is residing with his family in Kingdom of Saudi Arabia and has a permanent residence there. Now, Kingdom of Saudi Arabia, as you all know, is an Islamic nation as far as the laws are concerned. And as a part of that identity, Saudi Arabia applies Sharia law on those those domiciled in Saudi Arabia. Sharia law has an interesting aspect of forced heirship, where you don't have a control over your assets as to where the assets would flow after your death. There are some beneficiaries of those assets which are for sure you need to provide to them, irrespective of what you mention in any document concerned. So let's say Mr. X writes a will and wills away everything to his friend Mr. Y. Sharia would not allow that. According to the law, it must flow to the respective beneficiaries. Right. So that is one thing. Now the question which Mr. X would ask is, would I be subject to Sharia law on even my UK and Indian assets? So here is where interesting aspect comes in of the study of private international law. That is conflict of laws, as they call it. Now, as far as conflict of laws of succession are concerned, the general rule is movable properties would follow the domicile of the person. Immovable properties would follow the situs of the immovable property itself. So in our case, movable properties include the shares of the listed Indian company, which is written here. Mr. X, along with his family, resides permanently in Kingdom of Saudi Arabia. It is safe to say that he has a domicile in Saudi Arabia and not anywhere else. So, assuming that he is a domicile of Saudi Arabia, movable property that is Indian listed company shares would follow his domicile. That is, Sharia would be applicable on these assets. And as far as the UK assets are concerned, that is the land and real estate, these are immovable property, as we all know, and these would be subject to UK laws. Because these are situated in UK and Lex Citus, that is Citus of the immovable property governs the law which is applicable to it, is applicable. And these are uh, principles of private international law. Now, friends, I just gave you the conclusion of this case study. But how do you understand the source of learning on conflict of laws? So unfortunately, conflict of laws are not, as far as succession is concerned, at least, are not codified anywhere. There have been attempts to codify conflict of laws by international bodies. For instance, there is a Hague Convention on the law applicable to succession to estate of deceased persons 1989. However, only 16 countries are a signatory to this convention, and India is not a signatory to this Hague Convention on Succession Laws. There is also EU Succession Regulation 650/2012, which also tries to codify conflict of laws within the EU member nations. Uh, However, there are also some disputes within the nations because Germany would say that it is against my public policy or public order to allow people to jump the gun on my forced airship rules. So these are the aspects which cause some amount of ambiguity as far as conflict of laws are concerned. However, it is well established, and there are judge-made laws in across the globe pertaining to conflict of laws, and broadly, these are the principles which are reflected therein. Before moving forward, I would like to highlight that I mentioned domicile as a concept here, where movable properties follow the domicile law of domicile of the person. The concept of domicile is very different from citizenship or residency. What domicile means is, although it is not exactly defined, I'll try to put it in simpler terms. Uh, it is it is a place where you have your center of vital interest and you intend to stay till you die. That is, or return to or come back to from time to time, or want your ashes to be kept there, disposed there, etc. These are the definitions which the courts have mentioned here. Now, why Mr. X is a domicile in KSA in this case is that we have limited set of facts where his family entirely is a resident residing with him in the Saudi Arabia, and he has a permanent residence as well in Saudi Arabia. Hence, we concluded. However, practically, if you look at it, things will be very different. So we had a case where Mr. X would be residing in UAE for a business venture. His wife would be shuttling between UAE and India for maintaining some tax residency or some tax status, which would be beneficial to the family. Uh, he would have a business which he would be running in Switzerland. He would have a married daughter in India and a son who is in Singapore for the purpose of developing and growing his own business venture there. Where would his domicile be? Now, these are very fact-specific questions, and we need to analyze from case-to-case basis as to what happens to the domicile here. Coming to the specific instrument analysis. So, first, we'll be taking up Hindu undivided family. So, an HUF, as we all may already know, HUF is a creature of Hindu law. Hindu law, as I already mentioned, is partially codified. And so HUF tends to be a more or less unstable structure. And why unstable, we'll see in the discussion during this slide itself. The membership in HUF is by birth. There are no other qualifications, and the law is strict in this respect. So there is a complete lack of flexibility as far as your succession through HUF may be concerned. So meritocracy goes to the dogs when it comes to HUF. There is only membership by birth. That is what possibly I was trying to point out. There are three types of members, I would say, in an HUF. There is a Karta, a co-partner, and the HUF members, plain vanilla themselves. They have different rights. So, for the purpose of our discussion, we'll limit it to the relevant rights itself. Karta is also one of the co-partners in the HUF. His rights are equal to any other co-partner. However, he has an additional responsibility. What is the responsibility? He is the custodian of all the HUF property and assets and income. Uh, he is also the person who will be managing the estate of the HUF and dealing the property. So any deal regarding the HUF property would happen through the Karta. Does this mean he have an additional right? The answer is no, because this right of the Karta is limited by two principles. He must only transfer the property of the HUF in case it is a legal necessity, which is a very subjective term, and may be the root of many litigations in future. Or possibly the other aspect is for the benefit of the estate or the HUF itself. So these are the two cases where the Karta can transfer. And let's say one fine day someone wakes up and says, "Hey Karta, you transferred this without considering this aspect, and I think this was not a legal necessity or not for the benefit of the estate." Anyone can challenge the transfer itself, uh, and that can lead to horrible consequences for the family. Then there are co-partners. Co-partners can have one glaring right as opposed to other members of the HUF, is that they can demand partition at any given point in time. Uh, so they can demand partition of the HUF at any given point in time. So today HUF property may be intact in the same pool of HUF, and one fine day co-partner would come about and say that, "Hey guys, we need to partition this HUF. I need my share in the property," and you would have no recourse but to partition the estate. And so, from being family-owned property, it now becomes self-acquired or individually owned property, which can be again a horrible consequence as far as the succession plan of a person may concern. HUF members, these are the unfortunate parties in the HUF. They have no rights except that when someone demands a partition in the HUF, the HUF members have a right to a share in the HUF property. So they cannot demand partition themselves. But let's say a co-partner demands partition, then HUF members will get a share in that partition itself. Having understood these things, we'll clearly understand the drawbacks of having an HUF in place. There is a lack of clear title. Why am I saying this? Because or a threat of sudden partition. Why I'm saying this? Because if I were to buy a property from an HUF, and one fine day a co-partner challenges the transfer itself, that it was not legally necessary for the Karta to have transferred it, or it was not for the benefit of the estate, then it becomes difficult for me, because the transfer itself can be declared void at the instance of such person who is claiming so by the court, of course subject to him proving that the transfer was not for the benefit of the estate or legal necessity, and I'll be left with nothing. Unnecessary litigation will be upon me, whereas I had nothing to do with the HUF itself. There's a threat of sudden partition, where the HUF can be partitioned by co-partners at any given point of time. And this is where the stability point comes in. HUF, as a succession plan, it may be a trust, it may be a will, whatever. You want it to be stable so that you can clearly demarcate the exact flow of assets which will be taking place from you to your near and dear ones. However, where there is a sudden partition which is possible, the assets may flow at a point of time which you may not have intended for them to flow. And so this is another drawback of having the HUF in place. HUFs are also barriers to JV and M&A deals. How? Because let's say a joint venture happens and there is a 50-50 stake which is there. HUF is also a shareholder in that joint venture. There is an SHA in place, and the SHA considers the Karta through which the HUF is also bound. etc. That is somehow again a litigative topic, whether you can bind the HUF members through the Karta or not. One fine day, a co-partner again demands partition, and the shares have to be distributed among these individual members. Now, how will you bind the SHA? How will the SHA work out as far as the individual co-partners are concerned? Because you had initially envisaged only three parties or two parties. Now you have eight, nine parties due to the individual, partition. And so this is again a complication which may arise. However, the biggest drawback of having an HUF in place is a cross-border issues you may face going forward. Friends, HUF is a concept unique to India. So foreign countries may have laws which may not recognize HUF. It is, for instance, even in claiming tax credits, there may be an issue because India would say that HUF is a separate taxable unit, but foreign tax laws may or may not consider HUF as a separate taxable unit, may consider HUF as a tax transparent entity, or let's say it may completely disregard the HUF itself and consider individual taxation instead. So these are aspects which make HUF a further difficult structure to deal with in a cross-border scenario. There may be issues under FEMA because while FEMA clarifies that under the definition of person, HUF is one of the limbs. So HUF is a person as far as FEMA is concerned. However, the residence of HUF is difficult to determine because the definition is worded in such a way that it covers specifically individuals and corporates and leaves out structures which are in the middle like HUF, trusts, etc. There is also a possibility of gift tax instance in a foreign country when there is a contribution in an HUF or a partition from an HUF. So these aspects need to be considered when using an HUF or continuing with an HUF structure in any of your clients. How we work on this is we generally advise families on what are the drawbacks, and possibly if they have a very strong reason to continue, they would continue. Generally, the families would be averse to continue with such an unstable structure. Coming to gifts and family arrangements. Friends, all of us understand what are gifts. Gifts are inter vivos transfers without consideration. Inter vivos meaning between two living persons. So there must be two persons, both of them alive. Transfer can take place between them, and that should be without any consideration. That qualifies as a gift, technically speaking. Under Indian laws, gifts can never be revocable. That is, once given, it is given forever. You cannot not have a condition that if XYZ thing happens, the asset reverts back to me. That is not possible. Civil law doesn't allow that. Transfer of Property Act, Section 123, talks about this. 122. Gifts are risky succession tools because you relinquish ownership today itself. So commercial thoughts may be this way. You lose ownership today itself. There is an obvious risk. As I mentioned earlier, we have an example of a big garment industry leader which did the same thing with his assets and the power ended up being misused by the Dhoni. So that is an obvious threat which all of us can think of. Another threat or another drawback would be gifts don't have enough flexibility because once given, as I said, you cannot revoke those gifts. And so having lost control over the assets, it is difficult to be sure of your succession plan. Incapacity, however, is something which is planned automatically when it comes to gifts. So having given the gift, let's say someone is rendered incapacitated by maybe a coma or some illness. Having given the gift, you don't have the ownership. So the person who has the asset itself can very well operate the assets, use the cash flows for their benefit, and so on. So when we talk about gifts, are gifts useless instruments as far as succession is concerned? The answer is no. Why? Because you may consider this common practice which you may have seen even in yourself and maybe in others, that there is this idea of investing in your child's name or in your children's name. These are supposed to act as emergency funds. So maybe there would be a specific idea for which you may have started investing in that child's name. Maybe it would be education, be it matrimony, etc. These are the aspects which where gifts can certainly help. So emergency fund corpus is one of the use cases for gifts. However, you should never think about it for controlling stake of companies. So it can prove to be very dangerous for the company, the business, as well as yourself to have such a risky succession in place, unless you are so sure that it makes sense to go ahead with it. Uh, the next part is gift of overseas assets may be subject to gift taxes in respective countries. So this is where we come in with the technical aspects. US has gift tax in place, and so maybe a US asset gifted to a US person, US asset gifted by a US person is subject to gift taxes in US. And such gift taxes are prevalent in many other countries in the world like UK. Um, Gift may be subject to Indian income tax unless the gift is among relatives. So section 56 to 10 of the Indian Income Tax Act 1961 talks about gifts between two receipts of asset between two persons without a consideration or for inadequate consideration. And there they have given an exception as far as relatives are concerned. Relatives are defined very clearly in that although the definition is wide, it may leave out certain aspects. For example, gift from uncle to his nephew or niece is not covered by section 56 to 10 exception and may be subject to taxes under the relevant section based on slab rates, etc. Gifts are also subject to levy of stamp duty, and in case the gift is pertaining to immovable property, it is also subject to registration and registration fees. So these aspects also need to be kept in mind. And the last part is, as far as cross-border aspects is concerned, is FEMA. So foreign exchange regulations in India allow gifts. They do allow gifts, but in limited circumstances and subject to certain restrictions, which need to be evaluated based on the asset concerned. And the residential status, of course, of the persons concerned. There are family arrangements which are completely a judge-made instrument. So, what are family arrangements? Family arrangements are documents which govern how the assets will be distributed within the families and clarify their ownership rights, clarify their rights and interests pertaining to that property. Now, family arrangements are not governed by any law per se in India. They are purely dependent on judge-made laws. So, you may refer to Kale versus Deputy Director of Consolidation Supreme Court case 1976 3 SCC 119, where they had concluded that family arrangement, the main purpose of having a family arrangement would be to resolve or avoid disputes and buy peace of mind. That is the purpose. And if that is the purpose, then family arrangements are sacred documents and should not be and basically these are allocation of rights and not creation or transfer of rights. And hence these should not be considered as transfers or receipts, etc. Accordingly, taxation would be affected. And there are cases in various authority having various jurisdictions where they have said that Indian taxes are not applicable as far as family arrangements are concerned, be it capital gains or receipt of property. Stamp duty or registration, would that be applicable in family arrangement? The answer is it depends. This is a gray area and one must tread carefully when talking about stamp duty or registration under family arrangements. It is always a good idea to consult a specialist in this realm. What about foreign taxes and FEMA? Now, these are independent of whatever Indian laws may have said. FEMA would consider this a transaction a capital account transaction where the assets or liabilities, Indian or overseas, are altered, then you would be subject to these provisions under FEMA. Similarly, foreign taxes would also be applicable. However, the jurisdictional law may also allow for some exemption if family arrangements are concerned. Again, it's subject to the relevant local councils who may guide you on this aspect. So again, family arrangements are good instruments. However, one must read carefully as far as the regulations are concerned. The latest example of using or let's say latest public instance of usage of family arrangements was the Godrej family arrangement, which recently happened, where they restructured the entire businesses, listed, unlisted both, between the family members. Coming to the most popular of the instruments, friends, that is the wheels. Wheels are the most popular instruments. We all know about these, and they have been there since time immemorial. Uh, but there are some technicalities which you all must know as far as wheels are concerned. I'll be starting with the basics in India, and some aspects are global or such foundational aspects that are applicable to wheels across the globe. Will, as defined under 2 Clause Act of Indian Succession Act 1925, a will is a legal declaration of the intention of the will maker with respect to the will maker's property, which he desires to be carried into effect after his death. So, effectively, what it means is, which is also enshrined in the common meaning, as I mentioned, the Halberry's laws of England's definition of will. It's a declaration in the prescribed manner, prescribed by the law, of the intention of the person who is making it with regard to matters which he wishes to take effect upon or after his death. What this means is that wills are only applicable or enforceable after the death of that person. That is one glaring feature. Other is that there has to be a legal declaration. The declaration has to be in accordance with the law. And so, let's say Indian Succession Act talks about the testamentary capacity of a person. So, who can make a will? A will cannot be made by a person who is a minor. So, a minor making such a declaration under a document would not be a legal declaration per se. And it has to be pertaining to the property of the person. So, any random wishes which you may have mentioned in that document may or may not be binding as far as like a will. It has to be necessarily based pertaining to property of the will maker for that to be a will. Now, friends, wills are ambulatory till testator's death. That is, wills can be changed or revoked any number of times while that person is alive. However, wills become irrevocable immediately upon the testator's demise. So no one can mention in a will that, after my lifetime, my beneficiary X or my son, my daughter, etc. would be able to change this provision of the will. That is not possible. Wills become irrevocable and unamendable after the death of the testator. Wills can be in vernacular language as well. Legalese is not necessary. There can be any language. It can be Gujarati, Hindi, English, Marathi, whatever. However, precision is paramount. So there must be clarity in respect of the disposition you have mentioned the will. It can't be that I have two properties. One of the properties will go to X, the other will go to Y. Which property, where is it located? Everything has to be mentioned in as much detail as you can possibly do. And it should be as clear as possible. This would help even avoid disputes. And another aspect, a softer aspect, is recording the discussions which you may have with your counsel if you are taking help of a counsel. For instance, deciding on whether I would mention X clause in the will or not, or whether I should mention a condition in this or not. Recording these intentions will also help, and keeping minutes of these meetings in order to interpret the will in case there is a future dispute which may arise. Friends, who can make a will? Okay, sorry. Before moving on to the aspect of who can make a will, I'll just introduce the parties which are involved in a will. There are testators, there are beneficiaries, and there are executors. Testator is the person who makes the will, who owns the property. Beneficiaries are the persons who are recipients of the property within the will. Executors are the persons who are entrusted with the responsibility of carrying out the will of the testator. So actually ensuring that the properties reach the relevant person. And there are witnesses, of course. Witnesses are the persons who are there to attest the will and have seen the testator sign the will in his good health, etc. What all things that you can do through a will? You can do four things. One is you can dispose your property according to your wishes. You can appoint guardians through a will, guardian for a particular beneficiary or a minor. That is how it works. So you can select how the property goes. You can decide as to who will be the guardian of your minor child. You can revoke an earlier will by saying that all my earlier wills are hereby stand revoked, and uh, thereafter you continue. And the fourth is you appoint an executor. Appointing an executor is not mandatory. It is an option given to you. If you appoint an executor, that person will be subject to the duties of carrying out the will. If not, then the court will appoint an administrator, as they call it, under letters of administration, and that administrator will be subject to the same duties as the executor. What can be bequeathed under a will? So any property which can legally transfer during your lifetime can be bequeathed under a will. Who can make a will? So every person of a sound mind who is not a minor uh, can make a will. Can a deaf, dumb, or blind person make a will? The answer is yes. Uh, However, one must be very careful when this is the case. A blind person cannot be a witness because the law talks about having seen the person sign the will, and hence witnessing through a blind person is not possible. Can a person who is ordinarily insane make a will? The answer is yes, but only during the lucid intervals, not when he doesn't have control over what he's doing. Can an illiterate person make a will? The answer is yes, because the law provides that that person can attest the document by putting a mark, not necessarily a signature. So literacy is not an important thing. However, in all these cases, one must be very sure that the person signing the will or attesting the will must know exactly what property he is giving, to whom he is giving. He must recollect the extent of his property and the claims of persons who are included or excluded in his will. So these are the aspects which must be known to that person in order for them to have the testamentary capacity or the possibility to make a will. Can criminals or persons who have committed suicide make a will and execute them? The answer is yes. Can a sannyasi make a will? Interestingly, the answer is yes. Can an intoxicated or ill person make a will? Again, the answer is yes. However, he must be again aware of whatever I mentioned earlier. When do we check testamentary capacity? That is a capacity if the person is of a sound mind or and not a minor. So that is to be checked at the time of making the will and not at the time of death. The other question which may arise, who can be a legatee? Anyone, any person, any natural person, animal, company, etc. can be a will, and this has been also ratified by the Supreme Court in Krishna Kumar Billa's case. Basic must-haves in a will. So a will can be handwritten or typed. It can however, it has to be written as far as India is concerned. Can you have an oral will? There are only limited circumstances where you can have an oral will, and that to very specified person. Uh, a non-Hindu soldier or a seafarer would be a person who would be allowed for a oral will, and that too when that person is at the time of duty. It is valid for a month, and thereafter it becomes invalid. And so that is the only case where an oral will is allowed in India. However, it is always recommended that you should have a handwritten or typed will in place. You can have a sign or or a thumbprint of the testator, as I mentioned earlier. It needs to be attested by at least two witnesses, and this is a technical requirement which the law imposes on you. You must have at least two witnesses who have seen you sign the will and can testify that you were in good sound condition. You must clearly mention the beneficiaries and relevant properties. We already covered that. Notarize and register the will. This is not mandatory. However, it is recommended because notarizing and registering the will adds to the reliability of the document because it's signed by a judicial officer and a government officer. Uh, so that adds to it. Date the will and sign all the pages of the will in order to avoid any replacement or forgery after you are no more. You must appoint executors because then you'll be otherwise you'll be relying on the court's discretion as far as the administrators are concerned. And doctor's certificate would also be a good idea to have in order to uh, prove your testamentary capacity. So doctor certifying that you are in good sound health. Now, friends, coming to the cross-border aspect of a will. I think we are running short of time here. I'll just take you through these aspects in detail. Did your will cross border? So countries have their own formalities attached to the validity of wills. For example, there are countries where there is mandatory probate. In India, if you see, probate is not mandatory in all cases. Probate is only mandatory where you have executed a will in the state of Bombay uh, or Calcutta or Madras, or you have executed a will anywhere in India, but anywhere in the world, but that property is situated in either of these three areas, then that will has to be probated in respective courts. Otherwise, is probate mandatory? The answer is no, not in India. However, if you see in USA, probate is mandatory in most of the states. And by the way, states have their own laws pertaining to probate in US. It's not a federal issue. Uh, there are small estate exemptions for probate as well. However, broadly speaking, almost all states in USA require a mandatory probate. What about UAE? UAE also requires all of the wills to have probated to be probated. Probate is a process where you approach the court and the court give you a certificate that this will is proved before us and that it is genuine. Then any challenge to the will itself will have to be first a challenge to the probate. So that is how probate works. Probate basically is a certificate from the court that is a genuine will in layman terms. However, it is a very tedious process and people would generally like to avoid going through it. But unfortunately, these countries do have mandatory probate. Then there are differences in the personal laws of these other nations. For example, as we already saw, forced heirship rules are prevalent in Middle Eastern nations like Saudi Arabia. Then there are French laws which are also subject to forced heirship rules. There are German laws which are subject to forced heirship rules. Swiss cantons have their own forced heirship rules, etc. So these are countries where forced heirship applies, and due to these differences, you must be very well aware of how your will play out in these other nations as well. Testamentary capacity may also vary between these nations. For instance, in UAE, a 21-year-old person is considered a major, and an 18-year-old would be a minor in UAE. So that is a common difference which you would see in UAE and Indian laws. Foreign estate or inheritance tax to be considered, as already mentioned, these are very high duties. There are also provisions like marriage revoking your will. You'd be surprised to know that in India also a marriage may revoke your will. However, for Hindus this is disputed. But broad basis, if I speak, it would be the fact that a marriage revokes your will which you have made before marriage. Interestingly, in US, the things are different. US does not necessarily have all states saying that your will be revoked after marriage. What US provides is protection to the new spouse. So even though your will, which you made before your marriage, would not have your spouse name written on it, obviously. After marriage, the spouse automatically is deemed to be included in the will, and some part of the property would go there. This is what they refer to as permitted spouse law. So that is one thing. Now, these were the technical aspects which you must be careful of when talking about wills. However,
Sir, one question is there.
sorry.
Uh, So one question is there from the participant.
Okay.
Yeah, is the probate required before signing of the will?
No, no. So the probate is not required before signing of the will. Probate is something which happens only after you are no more. So that is an interesting question, and there have been a lot of discussion in technical circles. So ante-mortem probate is what they call this concept, which is not there anywhere in the world. A probate can only happen post-mortem, that is after the lifetime. So an executed will is subject to probate, not an unexecuted will.
More question is there. Can I suggest here or after the session?
I think you may decide. I may have to overshoot a bit beyond. How much time do I have?
So up to its session is up to 3.
So I think I'll be able to answer the questions later on also, because there are some aspects which I need to cover. Then we can break for question
Right,
answers.
right. Okay.
Yeah, thank you. Yeah, so coming back, yeah, we already covered the technical aspects, the cross-border regulatory aspects, whether probate is required or not, whether the differences in laws pertaining to wills in different countries and forced heirship, etc. But these are technical aspects. How do you tackle these aspects? How do you ensure that you have a smooth sailing ride across the jurisdictions which you are there in? So these are some technical tips which you may, or practical tips which you may take care of while executing succession planning exercise wherein a will is concerned. You must execute separate wills for all different jurisdictions where assets are located. Jurisdiction to be seen qua asset, not beneficiary, because as wills are documents which govern disposition of assets. Beneficiaries have very little to do with how the wills are affected regulatory from a regulatory perspective. However, you may be served well if you just put this question before the relevant local council and they can guide you properly. But this is the general principle. Execute separate wills for separate jurisdictions where assets are located. Why? So easy it becomes easier to comply with local laws. So when you go for a probate, it becomes easier to get the probate through because only relevant parts of the assets would be discussed therein. It also enhances clarity and flexibility as far as the will is concerned and the legal implications pertaining to that will are concerned. Once you have executed separate wills, you must be very careful when you amend these wills or revoke these wills. So for example, you have two wills, one for the assets located in UAE, one for the assets located in India, and you execute a document which says that my wills pertaining to Indian assets are stand revoked hereby, and this is the revised will which I'll be making. This is perfectly fine, but unfortunately, it may so happen that you word it in such a way that you end up revoking even the UAE will, which is damaging and may lead to some horrible consequences because that will would not cover UAE assets, etc. So you must be very careful in revoking or amending your wills. There are also practical challenges which you may encounter. So, as continuing with the earlier example, you have a will for UAE, you have a will for India. You would like to have multiple executors. So for a UAE will, you would like to have a UAE person, a person who resides in UAE to be an executor. For India, you would like a person who resides in India to be an executor. Is that the right way to go about it? If that's not the right way, then what is the right way? These are the practical issues which you may have to answer. And then probate processes also tend to be more or less same, but the authorities you are dealing with would be different, and they may have their own, different standards of giving probate. And so these tend to be lengthy and tedious processes. So you must plan early on as to how you will tackle these challenges. And what better time than discussing with your council itself, planning on these aspects. Next, that drafting is extremely crucial. That ensure that there is no conflicting provision within the two wills or three wills which you may have executed for separate jurisdictions. There should be complete clarity as to this will refers to only these assets and this other will refers to only these assets. And which brings us to the next point. Should you cross-refer each will in the other? So would you mention in the UAE will that for the Indian assets, you refer the will which I have made for India, and for Indian will, you will mention the same thing for UAE. Is that a good practice? The answer is obviously yes. It is a good practice to cross-refer the will. In fact, we can go one step ahead and we can consider having a master document, which would not be a will, but it would summarize the provisions of the two wills and mention that these are two wills executed for the purpose of easier local compliances, etc. And so that may also govern the interpretation around the document. And lastly, while we are obviously required to look at these laws in some detail or some aspect or the other ourselves in the foreign laws, however, you must always be very particular about coordinating with the councils or advisors across jurisdictions, because obviously an Indian or a, let's say, UAE councillor would not know the laws of the other nation as well, and so you would always have some other partner dealing with it, a partner in the succession planning exercise, and this partnering process needs to be supported by very extensive communication, written and oral as well. Wheels also have some FEMA aspects around it, and I have summarized the FEMA aspects here. There is a general permission as far as inheritance is concerned from where a resident inherits foreign assets from a non-resident, or a non-resident inherits Indian assets from a resident. There are other blanket permissions given which are regulation asset specific. So for immovable property, an NRI or an OCI may inherit immovable property from another NRI, OCI or a resident. There may be immovable property which a resident may inherit from another resident, but this immovable property is a foreign immovable property. And after having sold these properties, how much can you take back outside India? So the answer is maybe USD dollars 1 million per annum. These are aspects which are asset specific, and FEMA requires a different study of the regulation itself. And so it would be a grave mistake if one were to ignore FEMA regulations in the succession planning exercise. Uh, there is no clarity as far as gold, bullion, paintings, jewelry, personal effects, etc. are concerned under FEMA, but generally one could safely assume that these would be permitted inheritances under FEMA, subject to them being covered under the relevant regulation. Coming to the private trust aspect, one of the document which is in or an instrument which is in limelight very recently are trusts, private family trusts. What is a trust, and when are trusts useful? A trust, as defined in Section 3 of the Indian Trust Act 1882, trust is an obligation annexed to the ownership of the property. So it is an obligation. It is not a separate entity per se. It is a legal relationship. It is arising out of confidence reposed in a person and confidence accepted by that person for the benefit of another person. Simply put, what is trust? Trust is an obligation. Obligation arising from where? So arising from the owner's confidence which he has reposed in some other person. Who is that other person? That person is a trustee. And for whose benefit will he be holding the property? The beneficiary. So that is how you would look at a trust per se. As I mentioned, trust is a legal relationship where the owner of the property gives it to another person, and that another person is not the real owner of the property or its benefits per se, because he holds it for the benefit of the beneficiaries. The beneficiaries are the persons entitled to the benefits of that estate, and that other person is mandatorily required to pass on the property to them. Sorry, pass on the benefits to them according to the trust deed. Now, friends, is trust a separate legal entity? The answer is trust is not a separate legal entity. as far as Indian laws are concerned, and the concept of trust itself will tell you that it's not a separate legal entity. This is also confirmed by Honorable Madras High Court in Tyagsagar Dharma Vanikam case 1963 ITR, wherein they have concluded that trust refers to a description of settler, trustee, and beneficiary, and not a separate entity per se. This brings us to what are the rights or roles of trustees, beneficiaries, and settlers in a trust. So, settlers' role end when the property is transferred to the trustee. Settler is a person who owned the assets and has put the asset in the trust. He will be the person who would have drafted the trust deed, or at least as per his wishes, the trust deed would have been drafted, and the trust deed would be the document which would tell you which would tell the trustees as to how they have to deal with the trust, who are the beneficiaries, and why are and who are the trustees during their lifetime, after their lifetime, etc. And so the role of the trustees now would become simpler to understand, is to act according to the trust deed and ensure that the assets are managed and dealt with for the benefit of the beneficiaries. What are the relevant features of a private trust which makes it useful in a succession plan? So, friends, private trusts allow for multi-generation succession planning. How? So let's consider a case comparison. Mr. A has two children. He has 100 shares of his company, 100% shares of his company. He bequeaths these 100% shares through wills, possibly in equal proportion to both his children. Uh, After Mr. A is no more, the property would be split 50-50. No one has control now. After Mr. A's child, let's say child one, is no more, he has two children himself. He splits this 50% share into further into two parts, and 25-25 to each of his children. So now there are three shareholders, 25-25 grandchildren, and Mr. A's second child as 50%. This keeps on happening, and the shares ultimately are fragmented to such an extent that no person controls it, and there are possibilities of family feuds or acrimonious disputes moving forward. And even otherwise, this would not be a sound strategy for succession, because you are ultimately giving assets which are gradually losing value as soon as the control is receding. Now, what a trust would help you do is, the trust would hold all the assets, the entire 100%. Control would be with a person who is capable of managing the business, and that person would be the trustee. You would act according to the trust deed, you would vote on the shares, etc. However, whenever there is a dividend declared, whenever there is a capital gain proceeds which is received by the trust, these would be released to the beneficiaries. And who would be the beneficiaries? Possibly all of the family members of Mr. A, irrespective of whether they are capable of running the business or not, whether they're exerting enough efforts in order to run the business or not, etc. So this is how a trust can help. And this brings us to the next point, also covered by this example: separation of control and economic benefits. So trustee is the person who would control the property. Economic benefits would always be held and transferred to the beneficiaries. So this is how it can work out. One child is into business, one child is not into business. One of the child who is into business can be the trustee and can control the voting rights, etc. The other child who is not in business can also be a beneficiary. So two beneficiaries and one trustee. That is how logically it can play out. And it is a very helpful tool in that respect. Trust can provide added protection for some family members. So you may have a case where there could be a minor person, there could be a person who is there could be a family member who is disabled, specially able, etc. And you would want some additional protection to be provided to these individuals in order to sustain them, in order to ensure that they have a good life themselves. And so a trust can very well provide for these things through the trust deed, mentioning that the trustee must distribute so and so funds, use so and so funds for the benefit, for the medical treatment, for the education, etc. of that person. There could also be a case where maybe the founder is of good financial acumen, but maybe his spouse may not be as good a financial manager as you would want. And so they can always appoint a protector or an advisory board within the trust structure, where the advisory board or the protector person would come in and help that individual in order to, consulting as far as the finances are concerned, and the trust property is concerned. Another aspect is trusts are not mummified manuscripts per se. That is, it is not that once written, they cannot be altered. Even after your lifetime, they can be altered if you give the powers to your successor to do so. This is where it also trumps wills because it has extreme flexibility as much as you want. And so with changing times, you may want that some aspects are changed. Maybe there is an estate tax which India introduces, and a small tweak in the trust structure may help you achieve some reduction in your estate tax liability. You would not want that opportunity to be gone. And so you would want to provide for some at least powers of amendment. Another aspect is that no probate is required uh, as far as a trust is concerned. Unlike wills, wherein there is even some amount of probate which may be necessary, trusts do not require probate. And so these are good instruments as far as succession is concerned. Registration required only on settlement of immovable property. So Registration Act 1908 in India governs registration of documents, and it talks about mandatory registration of non-testamentary disposition of immovable property. Documents which have non-testamentary disposition of immovable property. This would lead to a registration fee and a stamp duty instance both. Another aspect which is different from wills in a trust is that these are applicable immediately on execution, or these are enforceable, come into effect immediately on execution. And so what you can do is plan for incapacity during your lifetime in the trust itself, which is not possible in any other document. And you would have to have multiple documents, maybe a power of attorney in case of a will, whereas trust is a single stop solution for both incapacity as well as death. So these are the aspects which make trust relevant, and you may select a trust subject to, materiality of these aspects in your particular case. Coming to the practical aspects, would it be preferable to have separate assets for separate trusts for separate asset classes? The answer is maybe depending on case to case basis, but the general answer is yes. Why? Because different asset classes may have different persons who would be governing that asset class. So, for instance, continuing with Mr. A's example, Mr. A had two children. One was into business. Maybe the other is good at dealing in real estate or has good eye for financials, paintings, etc. Financial assets painting. So that other person can be managing a trust which contains a trust property which consists of the real estate investments, financial assets like equity shares, securities, portfolio investments, etc. Whereas the other trust which houses the business, controlling stake of the business, can be managed by the other son who is good at that. The other thing is ring fencing the assets. So if let's say for some reason one of the trust has some liability attached to it, maybe you have given a personal guarantee in your business via the business trust. Uh, Possibly it would be a good idea to have the portfolio investments ring fenced into a separate trust rather than housing it in the same trust as shares of the business are concerned. So those are the aspects which you may consider in having separate trusts. Should you use professional trustees or select a person from within the family? This is a question which often come up in practice. And professional trustees have their own pros and cons, whereas a person from within the family is generally someone whom you would trust and would want to ultimately take charge of your property after the lifetime. And also it's obviously a personal preference which guides the decision, but as advisors we must always highlight the pros and cons of both the aspects. For instance, professional trustees would be charging some amount of fees, which would be a cost. However, they have technical superiority and compliances can be managed. On the other hand, a person from within the family may not be charging a fee, but his technical compliances, etc., would not be as good as a professional trustee who would have dealt with multiple trusts in his lifetime and knows how to deal with these aspects. So these need to be kept in mind. You must always provide for trustee succession. So let's say you provide in the trust deed that Mr. X is a trustee. After the trust is settled, Mr. X is a trustee. But the trust deed ends there. So it does not provide what happens if Mr. X for some reason is no more or is permanently incapacitated, etc. It should also provide that if Mr. X is not there, then Mr. Y. If Mr. Y is not there, then Mr. Z. And so that is how it should flow in order to continue the trust soundly for a long time. You must also try to keep the trust deed flexible. While you would like to lock most of the things, for instance, you would not want the shares which you may have given to your beneficiaries. There are three beneficiaries, you would have given them equal proportion. You would not want this to be changed after your lifetime, but at least keep some powers of amending the trust, as I also harped upon earlier, in order to adjust to the changing circumstances. It's always a good idea. Attempt must always be made to make the trust deed easily understandable for the family itself. And this is something very important for consultants like us who generally are technically so engrossed and used to reading laws and income tax act so much that complicated languages, explanations, provisos, examples, etc. make a bulky document which is hardly comprehensible by a layman per se, and the family may or may not appreciate these efforts of ours. So we must also endeavor in order to ensure that the family understands the trust deed itself, and the family is able to understand the trust deed even without our assistance pertaining to the same. And hence the drafting must be done accordingly. Lastly, careful thought should be given to the governance framework within the trust deed. So generally the trust deed would provide for how the decisions would be made for the purpose of the assets, maybe providing for disposition of assets, etc. And so uh, these are the some core provisions which you must be wary of when you are drafting a trust deed or designing a trust deed, discussing with the promoter. Power to add or remove beneficiaries, power to amend the trust deed, power to make decisions pertaining to sale or exit of assets, dispute resolution mechanisms, etc. These are the things which you must focus on when drafting the trust deed. And finally, coming to the main point, the cross-border perspective of private trusts. Selecting the jurisdiction is very important. So local law, how would you select the jurisdiction? So unlike succession laws, there is no robust guidance as far as the trust laws are concerned, where you could easily say that movables follow domicile and situs of immovable property is where the law applicable to immovable property is. There is no such guidance as far as trusts are concerned. So jurisdiction selection is essential. Local laws relating to ring fencing, you may consider these a country or a jurisdiction with good laws and clear laws relating to ring fencing of the assets within the trust is an important consideration. You may also consider compliances, the number of compliances. So, for instance, there are multiple compliances within India itself that you may have to do if the trust is established here. There may be a cost of operating the trust. The cost of operating the trust in the sense that a country like India or sorry, a country like maybe Mauritius would have a requirement, or a UAE would have a requirement of having local trustees, at least one local trustee or something like that. And those trustees would be charging something as a fee for trusteeship services, etc. These need to be kept in mind while selecting the jurisdiction. And once the jurisdiction is selected, you must have clear path as to how you will be design the trust deed, etc. But this is the first step, I think. Next is FEMA considerations. So FEMA does not have any provisions explicitly addressing private trusts. However, uh, these can be managed, and there are multiple cross-border private trusts which have been established. There are multiple interpretations which are possible in FEMA itself as to how the property should be looked at, and FEMA be evaluated for each transaction. Let's say settlement of trust, distribution to beneficiaries, investment from the trust. However, not going in those aspects in details. Again, dealing with FEMA is another important aspect as far as private trusts are concerned. And believe me, AD banks will also be having some conservative stands and aggressive stands, which differ across the board as far as private trusts are concerned. Then, of course, there are estate tax and inheritance tax considerations. Presently, neither India nor UAE have any estate tax or inheritance tax. However, US has a estate tax and inheritance tax, and private trusts are crucial in managing these estate tax and gift taxes. US has some interesting provisions. So there is a 15 million US dollar lifetime exemption available under gift tax and estate tax cumulatively. There is an unlimited spousal exemption as well. So gifting or bequeathing assets to your spouse will be to whatever extent is free from these taxes subject to some conditions. Trusts are commonly used to avoid estate tax implications. The structure becomes extremely complicated when you will have a practical case. You will see advisors giving advices where you will have to, the promoter will have to give up control of the entity he is talking about. And as professionals, we must take a step back and just see for ourselves as to what all the promoter is giving up in the wake of managing a US estate tax, and guide them properly as to not, no, you should not give up this much, right? There has to be some other solution for this, or else we can face the music and just pay the stamp estate duty. These are the aspects which they would be expecting from us, and we as consultants will be failed if we just focus on taxes. Another aspect is compliance is reporting for the trust, which need to be carefully studied. So generally, people would generally advisors like us would not concern themselves with foreign compliances as much, but these also need to be studied in some manner in order to ensure that a trust remains compliant even in the future. So, for instance, in India, we have Schedule FA in our ITR form, wherein we have to report, as also mentioned earlier, interest in foreign trusts. Similarly, US has this annual information report for grantor trusts. There is FBAR, that is foreign bank account reporting compliance, which needs to be done in US. There is another FATCA reporting which needs to be done in the US for grantor trusts. And so these are aspects which may be trivial in appearance, but may lead to some grave punitive issues, which may unnecessarily complicate things later on. Finally, foundations are structures which are very similar to trusts and have also gained popularity in jurisdictions which do not recognize trust. And so, the only point which I would like to make here is that foundations, foundations or like trusts, every country or every jurisdiction may offer some interesting succession planning tool. And as advisors, we must also evaluate these tools from these local advisors and consultants, and understand the extent of usefulness in your succession plan for the client. Again, coordination, as I said, amongst advisors across the jurisdiction becomes extremely crucial, even where private trusts are concerned. In fact, I would say even more so where private trusts are concerned, because these are complicated instruments as compared to wills. With that, I would like to conclude today's session by saying that death is not the end. There remains litigation over the estate, something which Ambrose Bierce, a famous US short story writer and journalist, mentioned. And it is not without, without substance that he said this, because while you may, while one may be planning for succession in order to ensure smooth passing on of the properties to the next generation or near and dear ones, there is always an aspect of clarity which it brings about in your thought processes as well as in the documentation, which is very essential for us as advisors to consider when talking about succession planning. So thank you for a patient hearing, and I think I'm done with today's discussion. We can take up the question answers now. You can go ahead.
Yes. So, yeah. So we have a couple of questions here.
Yeah.
Uh, yeah. So suppose that if the property is situated overseas, which is purchased by me when I was situated there, can an Indian will be sufficient, or is there an additional steps for ensuring the asset moves to the beneficiary mentioned in the will?
Yeah, so I think that aspect I have briefly covered during the discussion on wills. But what happens is, if there is an overseas asset and you have mentioned it in a will, there is no such thing as an Indian will or a foreign will. There is a will simpliciter, a document which prescribes as to how the property will go after my death. And that will has to be subject to the laws of that particular country. And to ensure that the overseas assets also flow to the beneficiaries of my choice, I will have to comply with those laws and collaborate with the local consultants to understand the local regulations, as I mentioned earlier. So, for instance, as I mentioned, for Saudi Arabia, there are forced heirship rules. For France, for Germany, there are forced heirship rules. And these rules would override your will. You must understand as to how you can work around these aspects and clarify within the bounds of the law to ensure that the will's assets flow to the chosen beneficiaries.
Right. Another question is, if will made in Hyderabad be valid for future immovable property acquired in Bangalore, or should we make two wills at each place and register them there at?
No,
What are the
so
challenges or potential issues for that?
yeah, so a will made in India anywhere other than the three locations I mentioned, that is Bombay, the municipal limits of Bombay, Madras, that is the presidency of Madras municipal limits of that place, and Calcutta. Except these three places, anywhere in the country, if you execute a will, that will is not subject to a probate. So except these three places, whatever place you execute, it is not relevant. It is not a relevant consideration for our purpose. However, if the will contains, let's say, a property located in these three areas, then again, this has to be probated in those jurisdictions. Now, when I talked about separate wills for separate jurisdictions, it was country-wise and not state-wise within the country itself. I think I'll limit my answer to that. Hope it clarifies.
Yes, sir. One question from my side, that's how do double tax avoidance agreements like the DTA will apply in the context of succession and asset transfer?
Yeah, so it depends on the instrument or the transaction you are referring to, right? It could be, let's say, an inheritance uh, through a will which you have disposed. So, an Indian disposing Indian assets through a will to a non-resident. In India, this would not be subject to tax. In the relevant jurisdiction, it would be subject to maybe estate duty. If that is the case, then you must check if the DTAA covers estate duty. It would not cover estate duty because these are generally subject to income tax uh, covers. These generally cover income taxes of the relevant countries. And so for estate duties, there are separate DTAAs. For instance, UK has entered into a treaty with India for inheritance taxes. So that is how you would have to look at things. Am I understanding your question correctly, or you
Yes,
had a different question?
yes, sir.
Yeah.
Any more questions for the participants? There are no more questions as of now. Should I close the session, right? So, ladies and gentlemen, as we bring this enriching session to a close, I want to extend my heartfelt thanks to all our distinguished panelists for their invaluable insights, and to our engaged audience for the depth of curiosity and perspective you brought to this discussion. Today's dialogue on legacy beyond borders, navigating cross succession, underscored one thing clearly, that succession is not merely a technical exercise, it's a human journey where law, finances, governance, and family values must converge to create continuity and harmony across generations and geographies. We touched upon core provisions of inheritance and succession laws, taxation challenges, governance and structures, and the evolving complexities of digital and cross jurisdictional assets. What emerged is that while each jurisdiction that has its own framework, the shared responsibility remains to plan proactively, address sensitively, and preserve the legacies in a way that is fair, lawful, and enduring. On behalf of the committee, Directorate, I thank each of you for a contribution, and a special gratitude to our speaker for bringing this conversation to life, and all the participants for being part of this collective journey. With these reflections, I formally close the session. Thank you, and I look forward for more dialogues that inspire clarity and collaboration across borders. Just a second, I'll check the questions. There are no more questions. We can close the session. Thank you. Thank you so much.
Yeah.
Thank you.
Okay, thank you. I can drop off, right?
Yeah.
Thank you.
Recording stopped.